Yeah, no problem. For promotion, even for your regular working in credit portfolio. So, sir, over to you.
Thank you, sir.
Thank you, sir, for joining us.
Thank you. Good afternoon, friends, and welcome to this CBOA's pre-promotion training class. I am very much thankful to my CBOA friends for giving me the opportunity, because earlier also I used to take continuously. I was one of the opening batsmen of RSTC Gurgaon in 2008. I was in Delhi also, RSTC. Now, briefly about today's session, we will go through. Yes, sir. Share. Sir, I think sharing PPT, sir, screen share, sir.
Sharing, sir. I will give share.
Please, please.
Sir, you can share now, sir.
Yeah, now it has come, sir. Share sound. That also can share.
Yeah, it is.
Now,
Yeah, it is.
yes, now it is coming, sir. Yes.
Sir, on the top of the screen, there is a menu.
Yes, sir.
What will be there? From
Yeah.
that, you can disable annotation, sir.
Annotations. Yeah, yeah, yes, sir. Yes, sir. Menu annotate, name more, you know. Disable annotation for others. So, disabled annotation for others, sir.
Yes, sir.
Yeah. Okay.
Yeah.
So, we'll proceed. Yeah. Good afternoon, friends. Let us start credit policy introduction first. Why this credit policy is this much important? You know? Now, just we see balance sheet of our bank. Our bank's main function is accepting deposits and giving it as loans and advances. This is what main function of bank. So we are accepting deposits. That means liabilities. We are accepting liabilities and converting them as assets. Loans and advances, it is assets in our balance sheet. And investments also, assets. Suppose if you accept 100 rupee deposit, say 100, instead of 100 rupee, we take 100 crore deposit here. Entire 100 crore you cannot give as a loan. So what you have to do, you have to keep 4.5%. That means 4.5 crores you have to keep as a CRR, that is cash. And 18% compulsorily you have to invest in bonds, SLR bonds we call. So that is SLR, 18%. 18 plus 4.5, 22.5% is already blocked, either in cash form or in government bonds and other bonds. So now leftover is only 77.50 crores here out of 100 crores. This only you can give as a loan, right? After 1 year, you have to pay back the depositors whatever 100 crores you have accepted at 4.38%. This is approximately our cost of deposits. So 104.38 crores you have to pay after 1 year to the depositors, right? Now let us see our assets portfolio after 1 year, how much it will be. CRR 4.5 crores. After 1 year, it will be 4.5 crores only, because we are not getting any income on CRR. Olden days, till 2003 or 2004, RBI used to give 3% interest on CRR. But more than 20 years ago, it has discontinued. Now we are not getting any income on CRR. RBI is not paying us anything. So at the end of 1 year, you will have only 4.54 as a CRR. Then what about SLR bonds? 18% you have kept in the form of bonds, so different types of bonds, SLR. So here average yield we are getting is 5.5%. It is approximately we have taken. So 18 crores will become 18.99 crores at the end of 1 year, right? Now, remaining 77.50, whatever it is there, this we have given as loans and advances. So this at the rate of here approximately advances 7.7% yield rate is there. We have calculated it is 82.93 crores. That means at the end of 1 year you will receive 106.42 crores in asset portfolio, whereas liabilities, you have to pay 104.38. Right? Now, are you sure that you will receive this entire loans and advances 77.50 crores, whatever it is there, you will receive without NPA, without OTS, without write-off, etc.? It is highly possible because risk is there. Since we are doing business, it is subjected to risk. Without risk, no business, and our business also risk is there. Some we have to put as keep as NPS, some slip to NPA, and we may have to go for OTS, etc. So we will lose some amount. For example, I will tell you, at present, you see what is our NPA rate. It is gross more than 4% is there, net to more than 1% NPAs are there. Say average, if you take nearly 2.5%, suppose if you are losing here, that means you will receive only 104 crores here, because in NPA you lost something. If you receive 104 crores, whether you can pay 104.38 crores to depositors, say we have kept aside our expenditure, etc., because commission and other income is also there. That means here you cannot pay to depositors if you are incurring loss at least to 2% or 2.5%. So we have to minimize the loss. What is there? In risk, we can minimize, but we cannot avoid completely. So you have to minimize the loss. To minimize the loss, whatever you have to do, this is all prescribed in our credit policy and also credit risk management policy. And another one step I will go further. Here you are getting loss and you are not in a position to pay to your depositors. Suppose if you say that your depositors, अरे बाबा हम कुछ लोगों को OTS में पैसा कुछ खो गया, and you also deposit में कुछ ना OTS आ गया, थोड़ा कम करो. Like that, if you ask what happens, it is a systemic risk will happen. Banks will collapse if you say like that. That means you cannot tell to depositors that you can reduce your amount. Yeah, thoda interest come karo like that. You cannot tell. That is systemic risk. Then what we have to do? So here what it says is, whatever losses you are expecting here, those losses are two types. One is called as expected loss. Second one is called as unexpected loss. Expected loss and unexpected loss. So expected losses we can calculate and we can cover those expected losses by way of, one is pricing, second one is provisioning. Pricing and provisioning. These two, it will be covered. And what about unexpected losses? Unexpected losses, it is beyond expected losses, whatever it is, standard deviation, they are coming. So to cover those unexpected losses, what Basel says is, don't pass on your loss to your depositors. To absorb your loss, you should have your own capital. This is what Basel Accord has come in 1991. Basel is telling you maintain certain percentage of capital. If you incur losses in your loans portfolio, don't pass on that loss to your depositors. You absorb that loss. To absorb that loss, you should maintain capital. How much capital you have to maintain? As per Basel III, in India, we have to maintain 9% capital in relation to your risk-weighted assets. Subsequently, Basel III has prescribed, apart from 9% capital, you have to maintain 2.5% capital conservation buffer, CCB. And apart from this, again, in future, you have to maintain another 2.5% counter-cyclical capital buffer, we call it as. Of course, it is not introduced so far. We need not worry about CCCB. So up to CCB, you have to maintain in relation to your risk-weighted asset, not exactly in relation to your asset. Risk-weighted assets. That what is that risk-weighted assets we see. And next, expected losses and unexpected losses, two things we are telling. Expected loss. How we can calculate expected losses? Equation is there. Probability of default, PD, into exposure default, into loss given default. Of course, maturity is also there, but these three important for calculation of PD, expected losses. So probable, this we can calculate, and we cover by way of, I told you two things. One is pricing, second one is provisioning. Pricing what? If you are giving loans to good rated party, you give at some lesser rate of interest. Or if you are giving loans to lower rate, that means a little riskier person, that means moderate risk or high risk, like that, you charge more pricing because they need more capital. This is called pricing. Provisioning also it is there. Now, expected losses we can calculate through by way of your risk rating exercise is there, what we are doing, credit risk rating. Of course, we are having 4 models. We will discuss all those 4 models, portfolio, small value, etc., etc. And we are measuring this credit risk through standardized method at present. What is the standardized method at present? Reserve Bank is telling you are not having banks, sub-banks at present, you are not having that much expertise to calculate what is risk involved in each loan account, and for that how much capital you have to maintain. So this calculation immediately it is not possible. So till that time I will give you figures. What is this figure? For each rating, how much risk weight you have to keep, and on that how much capital you have to maintain. This is what Reserve Bank has told. This is called standardized approach. In standardized approach, for each risk rating, Reserve Bank is giving us that risk factor where we can multiply. Yeah. We can multiply our exposure with risk weight given by Reserve Bank of India, and on that we have to maintain capital. For example, 100 crores loan you have given to a triple rated party. If you keep capital on total exposure, it is 100 crores multiplied by 9%. CCB we will keep aside for time being. So 9% means 9 crores you have to maintain capital. But that corporate is rated as AAA by ECI, External Credit Assessment Institutions. So this 100 crores, since it is AAA rated, Reserve Bank is telling for AAA rated borrowers, risk weight is 20% only. Reserve Bank has given this rate, not ourselves. Right? AA rated 30%, single A rated 50%, BBB 100%, BB 50%. Like that, Reserve Bank has given these ratings. Yes, sir, Amit sir. Yes, sir, slowly. Yeah, because this introduction I have not told the assignments. Yes. Yes, sir. Sorry. So Reserve Bank is telling this much, this is the risk weight given, and accordingly you calculate capital. This is called a standardized approach. Then if you migrate to IRB, advanced measurement, AMA, advanced measurements approach, in that again 2 types are there. One is basic and the second one is advanced. So you can measure your own risk. For this purpose, we have started our own risk rating since long. Earlier, what we have done is more than 2 crores risk rating ke liye, we have tied up with CRISIL and developed our own rating for above 2 crores. Subsequently, without now assistance of CRISIL also, we developed our own rating. It is called as CIRM. At present, we are using that. So basing on this, we can calculate our own risk weight. But if you migrate to advanced approach only, but at present, this IRB, we have not developed fully advanced measurement approach. So till you become expertise, Reserve Bank says, you follow only standardized method, right? This is what we are calculating expected losses by way of your risk weight. We calculate probability of default. It is PD. And second one is loss given default. For this calculation of loss given default, recently our bank has started facility rating, because in case of your credit risk, we are only risk, the outsiders, they are only risk rating. Sir, this is introduction. Actually, I have not kept this slide, because if you go to slide, yeah. Okay. Then I will skip and do that. Yeah. Friends, for these calculations, etc., it will come subsequently in slides, not in this main CRM policy. Just I am giving you only introduction for understanding purpose. And the remaining in our already I have given material and subsequent slides also it will come. So till that time, only for understanding, I am telling you introduction so that you will understand the concept. Then we will enter into the main content further. Yes, friends, right. So PD we are calculating basing on your credit risk rating, either external or internal, whatever it is there. And then exposure at default and loss given default. This loss given default ke liye, recently we have started facility rating in our bank. Above 7.5 crores, we have to do facility rating. So basing on this, we will calculate what is loss given default. Through this, if you migrate to advanced approach, then we can calculate our own capital. So this is briefly about our risk rating, why we are doing risk rating, and at present Reserve Bank, how it is coming to our support. Yes, with this introduction, we will go to further, friends, and turnover method. Of course, I will come for this later. Now, we will see the importance of credit policy. I told you, no, if you incur losses, we cannot pay back to our liability holders or depositors. That is why you have to minimize the risk. Suppose instead of 2.5%, if you incur loss of 1%, then we will end up with 1.5% profit. That means if you minimize risk in credit portfolio, you will get profits. If you don't minimize your risk in credit portfolio, you will incur losses. So this concept, that is why you have to minimize your losses in portfolio. To minimize those losses, what we have to do, it is prescribed in our risk management policy, right? So this is our credit policy. Now we will see how to minimize this loss. So bank is telling policy has developed and strategies also we are adopting to minimize losses. So what are the strategies? We have given selected target markets where we have to finance. So these target markets are divided into two types. One is trust areas, second one is non-trust areas. Trust areas means where you can lend without much restrictions as per our normal terms, conditions, etc. Like your starting from priority sector onwards, so many are there: agriculture, SME, etc., including your infrastructure, industries, everything comes under trust area. But non-trust area, there are four aspects are there in non-trust area. One is commercial real estate, lending to commercial real estate. Second one is non-banking finance companies. And third one is capital market. And fourth one is industries which do not have much growth potential. So these four are non-trust areas. We will see one by one. Definition of startup, it is given up to a period of 10 years from date of birth. Uska date of birth means if it is a company, we say incorporation. If it is a partnership or LLP, we say it is a registration. So from the date of registration or incorporation up to 10 years, and where its a turnover not exceeding 100 crores in any of previous 10 years, then we call it as a startup, right? Now, priority sector, of course, I am not covering because it will be covered separately. Then we are going for credit information. So credit information, companies are there for drawing credit information reports, that is CIRs, under individual accounts as well as commercial accounts other than individual. So what are all the credit information companies are there? TransUnion, Experian, Equifax, CRIF, Primark, etc. So how many credit information reports you have to take, and it is prescribed here. And in these credit reports, if you get again marks 750 and above, it is low risk. And it's 749 to 700 normal risk, 699 to 650 it is moderate risk, below 650 it is high risk. This is how we categorize basing on marks. Is the customer low risk person or high risk person, right? Now these are all now one CIR where you have to take, and more than one CAC where you have to take. This is only table only. You can go through. We are not spending much time on this. Wherever it is required, I will give you explanations, right? Now, for gold loans, it is one CAR, and non-individuals, commercial segment, these are also as per figures only. Suppose any in CAR, a party gets less than 650 marks. If he gets less than 60 marks, 650 marks, then up to RO head CAC, the proposal will be sanctioned by next higher authority. Above RO head CSC, respective CSCs only will sanction. Right? Now, Canada retail grade. So this is applicable for all retail lending schemes other than Canada pension, educational loans, and gold loans. So here also scoring band is given. Basing on this scoring band, again risk rating, risk grade we will do. If we is securing more than 95% marks, then we call it as CRG prime and low risk one, 80 to 95 CRG one, etc., etc. Right? Now, risk tiers for retail borrowers. Recently, bank has given instructions. Even our Jagannath sir also has talked about these two, and near prime and subprime, where you should not lend more than 10% of your total retail portfolio. That is what they have fixed limits. So accordingly, what they say is CRG3, and where CAC score 730 to 681, it is in case of CRG3 people, it is near prime, and in case of CRG3 CAC score 300 to 680, if they secure, it is subprime. So near prime and subprime, that means they are not that much low risk people. So you should be cautious. That is why restrictions are there. Maximum ceiling prescribed for them, as I told you, it is maximum 10% of retail loan sanctioned. And again, trigger point is there. What is the trigger point? You cannot wait till it reaches 10%. So up at some certain percentage of level, you have to stop further lending, go cautiously. This is what trigger point. So if you reach 9% for near prime people, then head office will tell, yes, already you are reaching nearly maximum. So you go slow or you stop like that. And similarly, subprime maximum 5% only it is given. Out of that, again, trigger point is 4.5%. Right? Now, real estate sector, lending to real estate. First one is non-commercial real estate and second one is commercial real estate. Two types. Non-commercial real estate means all types of housing loans. It will come under non-commercial real estate. Commercial real estate. I will tell you definition of commercial real estate. The definition of commercial real estate, you are lending loan for creation of additional space. Normally, real estate loans, the definition is creation of additional space on vacant land or on existing construction. If you are giving loan for creation of additional space on vacant land or on existing construction, it is called as real estate loan. As I told you, real estate two types, non-commercial and commercial. So commercial real estate means you are giving loan for construction purpose only, for creation of additional space. But here, repayments, the repayments, that means more than 50% of source for repayment. Cash flows में repayment के लिए more than 50%, where from those cash flows are coming. If it is rental receipts or sale of assets, then we call it as real estate. This is what the primary source of cash flow, that is more than 50% of cash flows. They are either lease rentals or sale of assets. Suppose you are giving loan for construction of one commercial complex. In that, the builder, what he will do, he may sell some shops or he may keep shops and give a rental basis, and he will collect rent. Then he will repay. So here repayment, again, it is linked to your repayment. Repayment is linked to how he is getting income. If it is a rental income, yes, up to 7 years repayment he can permit. If it is sale of assets, up to 3 years only, it is permitted. Right? Next, CRE-RH, another classification. About 5-6 years ago, it has classified separately. What is the CRE-RH? Several times this question also appeared in earlier exams. What they say is giving loans for construction of housing projects like apartments, multiple housing complexes, wherever. In those housing complexes, commercial space will be there, some space, either for schools or for hospitals, etc. If that space, commercial space, whatever it is there, it should not exceed 10% of total floor space index. Floor space index is nothing but total construction area. So commercial space in a residential complex should not exceed 10%. In such case, you can classify it as a commercial real estate residential housing. Here, not strict rules like CRE, a little bit leverage is given for them, right? And the next one is, you are not permitted to give loan for simply for construction of site. Vacant land के लिए हम नहीं दे सकते, लेकिन If party gives declaration that I will start house construction within 18 months, then we can give for vacant land also. Of course, our Canara site is there separately, that is separate scheme. Right? Next, another guideline it has given about 3-4 years ago. The builders or developers, whatever who are there, the construction people, they have to disclose in their pamphlets that this entire property is mortgaged to so and so bank, and we will release the mortgage and register in your name. Like that, they have to disclose with whom they have availed finance, and it is mortgaged to whom. Like that, they have to disclose in their brochures. This is another guideline. And housing loans extended to third unit onwards is treated as commercial real estate, because here again the definition of commercial real estate is repayment kahan se aa raha hai. Is it business profits? Then it is not commercial real estate. Is it rental income? Yes, commercial real estate. Or is it sale of asset? Yes, it is commercial real estate. So third unit means house के लिए एक आदमी 2 मकान में रह सकते, लेकिन तीसरा मकान में नहीं रहता. It has to give one lease only, rent only. So rental income he is getting. That is why here it is third is treated as commercial real estate. Just now Jagannath sir also told for third unit onwards you have to charge 0.25% early. Now it has come down to 0.1% extra interest than our normal housings, right? Now, commercial real estate, what are all the project parameters here? Maximum for single project, you can give maximum 500 crores only, or 3.33 times of tangible net worth of the borrower. This also earlier recalled question. How much amount you can give to single commercial loan project? Maximum amount. 3.33 times of tangible net worth of the borrower, or maximum 500 crores. And debt equity ratio not more than 3:1. Normally 2:1 it is for other general terms. Here up to 3:1 leverage is given. And promoters contribution minimum 50%. That is margin. Out of 50% again, 25% he can bring as advances from buyers. And the remaining 25% jo hai, whatever it is there, that should be his own money. But again, his own money also, we call it as equity, own equity. 25% he should bring margin. Entire 25% need not be his own. I will tell you, there is a general guideline. In case of project loans or long-term loans, the general guideline is that 25% margin party has to bring. It is general guideline. Out of 25% again, maximum half of that he can bring outside. That is called quasi-equity. Quasi-equity. Margin is owner's amount. Owner's amount mein uska own money will be there. It is called own equity. And some borrowed money will be there. It is called quasi-equity. Quasi-equity means if he is borrowing from outside, which are repayable in more than 12 years, or there is a subordination agreement from lenders to the borrower, then we consider it as a quasi-equity. So general in term loans guideline is that out of 25% margin, minimum half should be his own, and maximum half remaining can be outside borrowings, that is quasi-equity. But in case of commercial real estate, what they are telling is out of 50% mein 25% advance money, remaining 25% he should bring. So here at least 17% should be his own. That means not half year, almost 2/3 should be his own, and maximum 8% only quasi-equity is permitted. This is again a strict guidelines. मैंने बोला था ना इसको commercial real estate के लिए. Normal people ko half it is permissible, but for commercial real estate 2/3 he has to bring, right? And if land is not purchased, then 34% equity and 16% quasi-equity, because entire 50% he has to bring. If land is not purchased, 50% he has to bring margin. Out of 50%, his own money should be 34%, and borrowed money quasi-equity should be 16% maximum. Next, in case land is to be purchased from government, overall margin can be reduced to 40%. Instead of 50%, it can be reduced to 40%. Out of that again, 28% his own equity, and maximum 12% only quasi-equity. Debt service coverage ratio, it is 1.50, can be reduced to 1.25. You should remember in almost all 99% of term loans, I can say 95. 95% of term loans, DSCR is prescribed as 1.50 and it can be reduced to 1.25 by next higher authorities. Next, fixed assets coverage ratio 2:1. Fixed assets coverage ratio. What is this fixed assets coverage ratio? Fixed assets divided by long-term loans. This is what fixed assets coverage ratio. Fixed assets divided by long-term loans. You are telling 100 crores if it is a fixed asset. That means if it is a total project, only 50% we are giving loan because 50% is margin. Then 100 crores is total project cost and 50 crores is our loan. Then it comes automatically 2:1, right? Next, it is FACR and repayment period 3 years if it is a sale of property, 7 years if it is a rental. Already I have discussed this, and up to maximum 10 years tak ja sakte, no issue. Next, another recent guideline about 2-3 years back it has come. Branches or offices shall obtain collateral security, that is residential or commercial, whatever it is, in addition to the primary security. Normally, primary security is whatever we are financing and the party is creating assets, that is primary security. Apart from that, here, collateral security also you have to obtain at least 100%, that is what they have given. And recently, again, it is some leverages our Jagannath sir also told, if it is a moderate risk, compulsorily they have to bring 100%. And if it is a low risk, again, 75% to 100% it is at GM level, and 50 to 75 it is ED level, and below 50% high, it has to go to CAC. Like that, leverages are given. That already sir has discussed, so I will not go through in that. Next, all projects subject to project appraisal, CRERH, up to 5 crores exempted. In case of commercial real estate, normally, any project, in case of other loans, what happens is 10 crores, you should go for project appraisal. If it's the existing party, 20 crores or 15 crores, basing on his dealings, it has already come. But in this case, what irrespective of amount, project amount, he has to go for project appraisal. Only CRERH, where some leverages are given, residential housing, there up to 5 crores it is accepted. Next, LTV is monitoring tool for all construction real estate loans. LTV, what is this LTV? Loan to value. Numerator is liability including all expenses, interest up to date, etc., etc. Outstanding liability is numerator. And the denominator is your value of security. This is what LTV. Suppose 10 lakhs is house value. You are giving 7.5 lakhs as a loan. 7.5 divided by 10, it is 75%. So LTV, we call it as 75%. Generally, for this real estate, they say 75% should be. It should not exceed more. If it exceeds, what happens? Your liability is increasing. 7.5 lakhs se jada ho raha hai. How it is increasing? Either repayments are not coming or your value of property is going down. In that case only, LTV will be growing. So this is a monitoring tool which indicates that you have accepted 75% LTV at the time of sanction. Subsequently, it is growing means repayments are not coming or your value of property is coming down. So it is adverse effect. If LTV is coming down, yes, it is a good symptom. This is how it is a monitoring tool for all real estate project LTV. So at any point of time, it should not be more than what you have accepted at the time of giving loan. Right? Next, valuation to be done once in 3 years. It is general guideline. In case of SMA and showing some adverse, it is once in a year. Here for commercial real estate, there is no separate working capital limits we can sanction. Within project finance, term loan, whatever is total exposure we are giving, in total exposure term loan limits may certain percentage we give as working capital. Once that project is closed means this working capital also will be closed. It is not running continuously. This is what working capital ka bare mein isme. Then two issues here. One is National Building Code and second one is National Disaster Management Authority. Several times this question also appeared. NBC code is applicable for project loans exceeding 25 crores. National Building Code, there they have given guidelines. What is that? That fire service, that vehicle it should run round, something like that. Guidelines are there. So those guidelines NBC may that they have to follow NBC code if you are giving more than 25 crores. And second one is National Disaster Management Authority guidelines applicable for real estate exposures of 1 crore and above. So these two continuously they have to confirm, and sometimes we insist for certificate also, right? Next, capital market exposure. Capital market means share market exposures. So here main RBI ceiling is that capital market may total loans to capital market by a bank should not exceed 40% of our capital total. And and the direct investment in shares by us should not exceed 20% of our net worth. So one is total exposure to capital, maximum 40% of our net worth. And second one is direct investment in shares should not exceed 20% of our net worth. And generally, normally, margin 50% for any this against shares, or you are giving to share brokers. It is minimum margin 50% is prescribed. And in case of ad hoc, 20% margin only. And OD against property to these share brokers, we will give their 40% margin we prescribed. And another one is no loans against primary security of shares and debentures to other than individuals. For individuals, it is permitted. Again, 20 lakh ceiling is there, it will come. Other than individuals, no question of direct loan against shares, but we can accept them as collateral security. Right? Next, margin on advances issued. Issue of guarantees against shares or mutual funds. Whom we will give you? It is again for share and stock brokers. We will issue guarantee. There also they have to maintain 50% margin. Out of that, 25%, 25% margin we prescribe if shares are in demat form. Right now. Advance against units of mutual funds. When lock-in period is completed, then we can finance advance against mutual funds. And while financing, net asset value or repurchase price or market value, whichever is lower, that we consider as security. And loans to mutual funds within 20% of net asset of that scheme. Suppose some scheme is ending in next 6 months or 1 year. In such a case, what we do is, if they want for redemption of units, they may raise sometimes loans. So maximum we can give is 20% of that net asset of that scheme, maximum, and not exceeding 6 months. This is directly to mutual funds, right? Now, NBFCs, non-banking finance companies. Here, actually, only definitions sometimes they are touching here. Principal business for normally, while classifying, general condition is that in NBFCs, at least 50% they should give for physical assets supporting economic activity. It is general guideline, 50%. And for asset finance companies, at least 60% of their loans they should give for creation of assets. And 60% of income should come from such assets income. Right? Next, infrastructure finance companies. That means this NBFC will exclusively finance infrastructure. But up to what is the maximum? At least 75% of their loans deployed in infrastructure. That means this NBFC has given 75%, minimum 75% of their loans for infrastructure projects only. And 75% of its income also coming from such loans. Then we call it as infrastructure finance companies. And its net own fund 300 crores and rating is also AR equivalent. And their CRA, capital ratio, should be 15%. It accepts public funds. This is about infrastructure. Next, systematically important, core important companies. What is the systematically core important companies? These NBFCs are formed only to finance their own sister concerns, not to others. Their own sister concerns, their group companies or associates, for them also they will finance, or they may invest in shares of associate companies. Here, 90% of their assets are in group companies. Then we call it as a systematically core investment company, right? And out of that again, not less than 60% of assets in equities. This means by buying of shares would be 60%, and its asset size is 100 crores. Infrastructure debt fund. Infrastructure debt fund is nothing but just like mutual fund. They collect funds from public and lend to infrastructure companies, right? Next, NBFC microfinance institutions, that priority sector, maybe it is coming. 75% of its assets are qualifying assets. Next, factoring. What is this factoring? Factoring means purchasing book debts. If they are purchasing book debts, domestic book debts, then we call as factoring. If they are purchasing international book debts, then we call it as forfeiting. So here factoring means they are purchasing inland debts only. Non-deposit taking NBFC engaged in principal business of factoring. That means purchasing book debts only. So out of their total assets, 50% it should be factoring activity assets only. That means at least in their loans, at least 50% of their loans are given for factoring activity. Then we call it as NBFC factoring, right? Mortgage guarantee companies. Here 90% of their loans are given for mortgage activities only, right? Next, NBFC, non-operative financial holding company. If anybody wants to start a bank, to get license for a bank, first they should start NBFC, non-operative finance holding company. Then subsequently they will get license and convert it as a bank, right? So NBFC, some restrictions are there. Total borrowing should not exceed 16 times of the net owned funds if it is controlled by central or state government. In the 12 times of the net owned funds maximum in case of AAA rated, 10 times AA rated, 16 times it is for housing finance companies regulated by NHB, right? And recently they have given minimum asset coverage ratio for financing to their NBFCs also. Asset cover, what is this asset financing coverage ratio means? Total assets means total loans, their loans, how much it is there. Out of that, how much they have borrowed. This is what asset coverage ratio. So here at least it should be 1.10 for NBFC microfinance institutions and 1.25 for others, right? Now software, last year one question has come from this software. Margin generally 15% because it is very frequently obsolete. Then frequently it will be changing. That versions will be changing. That is why margin is 50% only. And margin on computer hardware 25 to 30% if vendor is having any agreement for frequent upgradation, because frequently technology will be changing. If vendor entered into agreement for changing this technology frequently, then 25 to 30% margin we can prescribe. Repayment maximum 3 to 4 years, right? Financing of producer films. I say पिछले 10 साल से मैं सोच रहा हूँ कि ये क्वेश्चन नहीं आया, लेकिन लास्ट ईयर 2 एग्जाम्स में हमारे एग्जाम्स में इसको दे दिया. Last 10 years I could not find this question, but last year surprisingly in 2 exams, our exams it has come. Only 2 points are there in this. In 2 exams, these 2 points asked. One is producers who have got a good track record of 5 years and not a defaulters with that film development corporation. They are eligible. And what is their maximum finance is only 35% only we will give finance for each project. Baki 65% where it is coming, 25% is their margin and 40% is coming from advance from distributors. But only one question in this, last year it has come. Now, bills discounting. Here one condition is that in bills discounts may, those who are having sales turnover of 50 crores and above, they should disclose aging schedule. That means they will have debtors. The debtors age-wise they have to give. This is only condition, right? Next, bills. If you are discounting bills against BULC may, if other bank is giving LC, in such case it is exposure on other bank for our capital purpose. Exposure on other bank. That means risk weight will be less. If our own bank has given LC, then it is exposure on borrower, right? That is only condition here. Next, STCLs. What are these STCLs? Short-term corporate loans. Generally, it is given for good corporates for short-term period only. For short-term mismatch, what happens is sometimes usko आने का funds है ना, वो तो delay हो रहा है, short period में आएगा. So till that time, we have to support them. We call it as short-term mismatch in cash flows. We call. For that, we will finance STCLs. Again, 2 types here STCLs. One is secured STCL. Second one is unsecured STCL. Secured STCL, it is for maximum 12 months we will give period. At a time 6 months. One time it can be extended by another 6 months. So maximum 12 months only for secured STCLs. Right? And it is to be availed within 3 months. Whereas unsecured STCLs, maximum 6 months only we will give. And they have to avail within 30 days. And moreover, it should not be more than 2 tranches. Each disbursement we call as a tranche. So maximum 2 tranches here. And next, corporate loan scheme. It is also a similar loan, but it is given for longer term. Maximum repayment is 60 months here. Right? Consortium advances. So 2 guidelines in this consortium advances. One is minimum at least 10% share we should have fund-based limits may. And whatever bills and other non-fund based, whatever it is there, they have to share proportionately among all consortium banks. This is the guideline. And sometimes in banking consortium, they are asking one question: what about classification of each advance? In different banks have given loans. So, as far as consortium is concerned, Reserve Bank is telling individual banks recovery. You see, if in Canara Bank recovery is good, yes, we classify as standard assets. In State Bank, it has become NPA, doesn't matter. But our bank recovery is good, so we classify as a standard asset. This is what Reserve Bank is telling in case of consortium. लेकिन JLA में ऐसा नहीं चलता. एक बैंक में NPA हो गया, दूसरा बैंक में भी करने के लिए Reserve Bank is telling, right? Now, multiple banking arrangements, MBA. Here, multiple banking arrangement means अलग-अलग banks and अलग-अलग their terms and conditions, अलग-अलग rate of interest, etc. But only thing is, because here without knowledge or something, we can say he is taking from different banks with separate terms and conditions. No common terms and guidelines here. That is why here we should be cautious. First one is pari passu charge over security hypothecated. So whatever securities are given, pari passu charge means in proportion to our lending. Say 100 crores is security, 100 crores is loan given by 3 banks. One bank has given 20 crores, second bank has given 30 crores, third bank has given 50 crores. So 20 crores given bank को 20% security में right आता, 30% जो दिया लोन उसको 30% security आएगा, and 50 crores loan जो बैंक दिया उसको 50% security में आता था. This is what pari passu charge. Proportionate to their loans, they will get charge on their assets. Right? Next. And MBMA, another guideline is that half-yearly chartered account certificate they have to give. In that, they have to disclose in which bank they have taken this much like that. Number one. Number two, whenever renewals or extensions are there, compulsorily bank has to disclose all loans raised by other banks. Total, he has to give. And exchange of information among member banks is also important. So these 3 points for MBA. Next, joint lending arrangement. About 4 years back, Reserve Bank has come out, 4-5 years हो गया, with this JLA arrangement. What Reserve Bank is telling is, MBA में कुछ problems हो रहे थे, अलग-अलग banks, अलग-अलग सब नहीं चलता. Whenever borrower is raising 150 crores and above from more than one public sector banks, their formation of JLA is mandatory. Wherever borrower is raising or having exposure of 150 crores and above from more than one nationalized bank, public sector bank. In such case, formation of JLA is mandatory. And that is for BBB rated companies. Below that rated height, less than 150 crores ko bhi JLA formation is better. This is about JLA. Next, time frame for issue of NOC. This also last 2-3 years it has appeared. Of course, last year this has not come. Earlier it has appeared in exam. What is this NOC? I will tell you. Now 3 banks has given loan to a customer. Each bank 50 crores. 3 into 50, 150 crores usko loan de diya party ko. Subsequently, he need another 50 crores. So existing bank anybody can give, or some other new bank also he will request and that will come and give. Fourth bank also आने का chance है. In such case, borrower has to ask NOC if he is raising from already existing banker or new banker. First, he has to request this. He has to submit request to existing banker. In case of consortium, lead banker को पूछेगा. In case of MBA, who is having major loan share, उसको पूछेगा. In such case, what that lead bank will do? First, party will submit letter to lead bank. Lead bank has to take a decision by consulting other banks. 15 days they will take whether to give NOC or not. 15 days हो गया. Then what lead bank will do? It will send sanction to its head office. We have to give NOC. This person is taking loan from another fourth bank. इसको NOC देना है. He will recommend to your head office, that lead bank. So 30 days it will take. So now 45 days हो गया. And after sanction by lead bank, he will tell other member banks also, अरे बाबा हमें sanction आ गया, आप भी हमारा sanction लेके, you go to your own banks by taking our sanction memorandum. Basing on our sanction, you also get sanction from your banks. So then those banks also will get 30 days time. Now कितना हो गया? 15 days for taking decision, 30 days taking for lead bank, and another 30 days for member banks. Pura 75 days ho gaya. So maximum permissible for NOC or pari passu charges 75 days. If they ask for lead bank, 45 days. If they ask for member banks, 75 days time. And rejection, it should be done within 15 days. So this is about NOC card, right? Syndication, another concept. We call it as loan syndication. What is this loan syndication? Here, loan syndication mein, one borrower needs 200 crores finance. He will come and approach Canara Bank. He will give his project, total project jo bana diya, sab Canara Bank ko de dega. Now, what Canara Bank will do? It will prepare one information memorandum containing full details, because Canara Bank, it doesn't want to take full amount. ये तो 50 crores or 100 crores देने के लिए तैयार है, बाकी 150 or 100 crores it has to arrange from some other banks. So customer will come and request one bank. It is called as mandated bank. And this bank will prepare full information about customer basing on financials submitted by customer, project report or financial submitted by customer. That is called as information memorandum. This information memorandum will be circulated among intending bankers. Other bankers ko de dega. So whoever ready to finance, this Canara Bank or lead bank, whichever na first approach kiya na, this bank will negotiate and arrange finance to the party. So he is first coming and approaching bank, that is called as mandated bank. This mandated bank is arranging finance from other banks also. For that they take charges. Our head office mein separate wing is there syndication ke liye. This is what syndication, loan syndication, right? Next, scheme for financing Indian companies for acquisition equity in overseas companies. Suppose our Indian company, it want to expand and in abroad. So there they have to keep some equity na, usko acquire karne ke liye maximum how much you will give. So eligibility, first one is tangible net worth should be 100 crores. And minimum loan quantum is $1 million, maximum twice the net worth of the tangible net worth of the company. And the term loan either in Indian rupees or in foreign currency. But maximum repayment is 60 months, can be extended to 72 months also. Bus. Next, FCLR, foreign currency loans to residents. This is also 2 years back recalled question. 3 currencies. They asked about currencies. FCLR is given in 3 currencies: USD or GBP or Euro. Here. Next, collateral security 125% is required for moderate risk accounts other than PSUs. Second one, minimum loan should be 1,50,000 in case of working capital or term loan, and minimum $50,000 in case of short-term import financing. Right? For liquidation of existing loans, also we will give. In such cases, the residual tenure of that loan should be 5 years, not less than 5 years. So, next. Granting FCLRs to NBFCs. NBFCs now certain restrictions are come. They can raise FCLRs also. But here for AAA rated company and maximum quantum is $5 million. Repayment working capital 1 year and term loans 3 years. Right? Okay, OPL net means yes, Purana high. We need not go. Secured OD booked statements 166 months. Next, lending to infrastructure investment trust. Earlier we have seen one trust. Similarly, this also. Infrastructure investment trust is also just like mutual fund. What they will do? They collect money from public and pool that fund. This fund they will invest in infrastructure companies, and particularly they invest in infrastructure companies for taking share. That means those who are investing in this company, indirectly they are investing in some infrastructure company, because this INVIT only intermediary. So such INVITs ko we will give finance. Here, what are all the restrictions here? Bank finance should be restricted to 50% of finance required for acquiring promoters' contribution, whatever it is. Right? Next, holding of INVIT, and this is sponsored by some other NBFC. Uska net worth should be at least 1,000 crores. This is another guideline. And aggregate exposure ceiling for financing IN 1,000 crores. That means maximum we can finance to INVITs is 1,000 crores only. For individual INVIT, maximum 100 crores. This 100 crores is for other trusts. Maximum our exposure ceiling, it will come in next session. 100 crores is for trusts and association. So for this similar condition apply. So single INV IT co we can give maximum 100 crores only. For entire INV IT co we will give 1000 crores, right? Margin 50%, DER 1:1, DSCR 1.50 common, maximum 7 years repayment. And one condition here is that the trust is required to invest at least 80% of its value in completed projects and revenue generating projects, assets. This is the condition. Recently also again, government has reiterated. So important for exam purpose at higher level, right? 80% they should invest in completed projects and revenue generating projects only. Right? Interbank participation certificates. Interbank, this is securitization. One bank is selling assets, other bank can purchase those assets. This is what interbank participation certificates, particularly in case of priority sector. Suppose you are having shortage of priority sector loans, you can buy pool or bunch of priority sector loans from other banks. That is what interbank participation certificates made. So period is 91 days to 180 days if it is a risk sharing, and 90 days maximum it is without risk sharing. Risk sharing means the entire asset is transferred. If it is loss incurred means we will incur, purchaser will incur loss, right? Yes. Yeah. 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 Next, co-lending. This is also recalled question last year. Co-lending. Here, what is this co-lending? NBFCs, they will finance to parties. In the beginning itself, they will negotiate with us. Sir, we are giving finance to so-and-so party, some parties, this much amount. Out of that, whether you will come with us. So what happens is they will have network in small areas, rural places, etc. There they can lend. So we also tie up with the NBFC for extending loans. First, NBFC, what it will do? It will sanction loan and disburse loans to individuals or parties, whatever it is there. And to all these loans, they, what you call a pool. And out of that pool, they shift us 80%. And they can retain maximum 20%. So what last year's question was, NBFCs in co-lending may, how much they can retain maximum? Up to 20% of share they will retain, remaining 80% they will shift to us. So again here agreement will be there, like securitization agreement. Here also they will transfer. Securitization, what happens is different banks, they might have given loan and transfer to other banks. The transferring bank, how they will get rights? So they will endorse those loans. Similarly, here also, NBFC will take entire documentation and they will endorse those loans to Canara Bank for 80% of your share. So last year's question is how much they can retain? 20%, right? So digital lending for framework. Here it is nothing but end to end, everything is digital. People will approach through digital, entire KYC, etc., everything will be done digital only here. Only thing is annual percentage rate. Here means per annum interest and other charges, how much you are charging, that is APR. We have to disclose transparently, all inclusive costs. And cooling off or lookup period. What is this lookup period? If that borrower, intending borrower, after seeing our terms and conditions, if he doesn't agree for our terms, he can say, yes, I don't want this loan. Just like your insurance policy maker, what is there? 15 days, they will give time. Within 15 days, if you don't like, you can reject. Similarly, that is called lookup period. So here also, lookup period is there, right? And key fact statement. Recently, it is very famous, key fact statements. What is this again? Annual total rate, annual percentage rate they have to mention. Key fact statement may all your terms and conditions you have to disclose to the party. And any rates you have mentioned in key fact statements, it should not charge more than what you have mentioned in this key fact statements. All expenditures, etc., everything you have to mention in this key fact statement. Okay, default loss guarantee up to 5% somebody will give guarantee. This is default loss guarantee, and bank will invoke this within 20 days, 120 days default. Yes, friends, now we are going for operational process and systems at branch level. What we have to do as per policy. This is what operational. So here, all our proposals of 1 crore and above, we have to segregate. One is relationship functions, second one is appraisal functions. Relationship functions means maintaining liaison with the customer. Appraisal functioning means separately we have to assess all financials appraisals. This should be done separately, right? And submission of credit proposals, large, yeah. Here, earlier guideline was separate. Now, what is our guideline is LCBs, that is large corporate branches. If it is a circle office power, yes, they submit to circle office. If it is a head office power, directly they submit to head office. A copy endorsed to circle office. So circle will give within 2 days its views to head office. This is submission. Similarly, MCBs also, if any HO power accounts are there, mid-corporate branches, they have to send a proposal directly to HO, copy to circle office. Circle office will send a front sheet, we call, within 2 days to head office. Front sheet means important figures and also its recommendations will be there. And fresh proposals of 10 crores and above shall be handled by only MCBs wherever MCB centers are there. Right? Next, submission of credit proposals by branches falling under the power of circle office. Because ROs also there in between. In such cases, you have to submit directly to CO with a copy to RO. Similarly, within 2 days, RO will send front sheet to circle office. So these guidelines are given to minimize turnaround time. Yeah, from here it has to go to circle regional office. From regional office again they keep and send it to circle office. So instead you send it directly, a copy to regional office, so that it will reduce turnaround time. Right? Next, MSME branches, submission of credit proposals of MSME by branches beyond the cumulative cutoff limit of 25 lakhs. Because MSME proposals up to 25 lakhs, if branch powers are there, they can do at branch level. Beyond that only, they have to send. Participation in bids or quoting rates. This happens in case of bigger loans, particularly from public sector undertakings or government loans, central government or state government. Sometimes they will be raising loans. In such cases, what they say is they collect bids from different banks. So this government department or this public sector department, they ask different banks, sir, we require 1,000 crores loan for 6 months or 1 year period. And what is your rate of interest, other charges you mention, processing charges or your other charges also you mention. Like that, they ask different banks quotations we call. So we have to give quotation to that public sector undertaking. So who will take decision here? Up to 300 crores, ED will take decision. Beyond 300 crores, MD will give quotation. This is in their powers, it will come. Right? It is again valid for 6 months only. After that, again, fresh quote has to go. Next, audited balance sheet. For availing credit facilities, party has to submit audited balance sheet. Which audited latest one it is required? Here it is given T-2 or T-1. I will tell you, now it is October month. October month. When party has to submit balance sheet, it is within 7 months from closure of March financials or within 15 days from the date of adoption of accounts. Okay, adoption, chhod do. When it is, we don't know. So 7 months from the close of March financials. That means 31st October is deadline for submitting audited balance sheet. Party has approached you between April and October. Now October month. Party approached. But for submitting to 2024 balance sheet, still time is there. You can't ask this year balance sheet you give. So which balance sheet audited you will ask? Previous year ka. That means current year is T. Last year ka means T-2 it will come. T minus 1 last year. Right? Suppose party is approaching in November. November is approaching means already balance sheet due date is over. 31st October we might have received. Then we insist for 2024 balance sheet. Sorry, this is T minus 1. Earlier one, T minus 2 it will come. Because current financial is 2025. Current financial year. So if he is approaching in October, we are asking T minus 2. That means 2023 audited balance sheet we are asking. Because 2024 balance sheet is not ready. Still time is there. So T minus 2. If he is approaching after October, automatically current year balance sheet is ready. Whereas October now month is belongs to 2025 financial year. So 2025 financial year is T. 2024 balance we are insisting. So T minus 1. This is how we have to call for balance sheet while processing or submitting proposals. Right? Next, if financial statements, audited balance sheet submitted by the party is more than 6 months old, in such cases, for either fresh limits or enhancement, whatever it is, so what they have to do is latest to provisional financial statement they have to submit. For example, party now is approaching, it is October, and he is submitting audited balance sheet of 2023. Now almost from 2023 March to now it is more than 1 year. In such case, we should insist for latest financials. If balance sheet is more than 6 months, then we should insist for latest financials. Unaudited, not audited. Right? ABS is not required for agricultural loans up to 1 crore. It is not required. Beyond 1 crore also, RO, CAC, AGM, RO, CAC, they are having powers to waive, but additional risk premium 0.25% is applicable. We will charge 0.25% extra because financials are waived. This audited balance sheet is waived for agricultural loans. This now. Okay. Next. And whenever party is submitting audited balance sheet, we have to verify in Ministry of Corporate Affairs website because it is mandatory for corporates to upload their financials in MOCA website immediately after auditing. So there they cannot modify that figures. As it is, whatever figures are there, they will upload into MOCA, Ministry of Corporate Affairs. So we have to cross-verify with the balance sheet, whatever party is submitting to us, we have to cross-verify with the MOCA website. These balance sheets are available there. With those balance sheets, we have to cross-verify. And the chartered accountants, wherever they are signing in balance sheets, etc., they have to put their UDIN number, that is identification number. And these identification numbers, you can verify in ICAI website. Institutions of Chartered Accountants of India website. So these are all fraud preventive measures to prevent that party may submit adjusted financials like that. Okay. Next, if limits are above 5 crores, passport of the promoter or promoter director you have to obtain. So wherever limits are exceeding 5 crores, already Jagannath sir told, you have to collect passport, Aadhaar number from the party. Next, legal entity identifier. It is a 20 digits alphanumeric code. Now, at present, 10 crores and above, it is mandatory. And by 30th April 2025, 5 crores they also have to submit 5 crores and above this LEI, legal entity identifier. It is internationally same code it will come. In India, CCIL, Clearing Corporation of India Limited, its subsidiary is giving us this in India, this legal entity identifier. So non-individuals, they have to obtain this LEI. It is to be incorporated all the proposals and financial transactions, etc. So this is legal entity identifier. So international, it is one identification number for these corporates, non-individuals. And economic intelligence guru, just now Jagannath sir had told, if it is crossing 50 crores, any person is approaching you for 50 crores loan, then you call for report from Central Economic Intelligence Bureau. Or if 50 crores and above any loan is becoming NPA, there also you call report from Central Economic Intelligence Bureau, right? Next one is group risk assessment. What is this group risk? I will tell you. There are 4-5 accounts are there interrelated. That means they are common, they are having common directors, or majority of directors are common. So these we call as a group companies. What happens here? If one account or one company is in trouble, naturally other people will try to help this company. Other 4 are, suppose 5 group companies are there. If one company is in financial trouble, other companies will try to adjust money. In such cases, what happens? They also face some financial trouble because their money is diverted. So such a problem is there. It is called as group risk. Group risk means if one account fails, other accounts also of that group. If one account in a group fails, other accounts of that group also likely to fail. So this is called as group risk. To assess this group risk, what our bank guidelines are that key financials, whatever it is there, key financials means one is turnover, net profit, leverage, T&W, liquidity. So these key financials are major group companies. What is this major group companies? Wherever holding is more than 30%. Say A is parent company. This company has invested 50% equity in B company. It is a subsidiary, B company. So now both are group companies. So since A company has invested 50% in that, compulsorily these two are interrelated. And while sanctioning loan to A, you have to assess B also. While sanctioning loan to B, you have to assess A also. This is what group financials interlinked. So wherever more than 30% stake is there in that business by other company, in such cases, you have to see turnover, net profit, leverage, tangible net worth, and liquidity. These you have to monitor. If one account is suffering any of these ratios, then you have to watch other account also, other pharmaca accounts also. If A company is having some trouble, you observe B company also, because both are interrelated group companies, right? This is how group risk assessment. Okay. Now we go for working capital assessment. So 3 methods are there. One is working capital turnover method. Second one is MPBF, and third one is cash budget method. What is this turnover method? It is also called as PR Nayak committee recommendations. PR Nayak committee. So here 20% of projected gross annual sales turnover accepted by the bank. This I will show you here. The other slide is there. Through that I will explain. Yeah. Turnover method. Okay. Say 40 crores party has submitted. Next year, my turnover will be this much. My sales will be 40 crores. Party has submitted as balance sheet. Next year's projections party has given. First of all, you have to accept, is it reasonable or not? How you feel that is it reasonable? Suppose if current year turnover is around 30 or 35 crores, okay. Next year there will be growth of 10%, 15% or 20%. So 40 crores is acceptable. Instead of that, current year, full year he has done business and 24 crores only is turnover. Now he is giving next year I will do 40 crores turnover. So is it reasonable? You have to think. When it will become reasonable, if this fellow is adding any other machinery for other work or any enhancement is there, in such case we can accept. Without that, simply same terms, conditions, same unit only, there is no enhancement in his production. In such case, we cannot accept. So projected turnover, you have to accept if it is a genuine one. And if you are accepting, yes, then on this you have to calculate. What you have calculate? What you have to calculate? 10 crores. 10 crores is his projected turnover, and 25% of this is called as working capital requirement. This is working capital requirement. Keep in mind, not working capital loan. 25% of projected turnover is working capital requirements. Out of this, again, 5% of projected turnover is margin. 5% of this projected turnover, how much it is? 0.5. So now 20% of projected turnover are A minus B. This is permissible bank finance. And here another one problem is there. Suppose party is having net working capital more than 5%. Say here 0.5 crore is your 5% of turnover. And we have given here example 0.4 crores is available net working capital in this. So how much margin we take here? Either 5% of projected turnover or available net working capital, whichever is higher, that is margin. Here, either 5% of projected turnover or available net working capital in the system, we consider it as a margin. So here 10 crores is projected turnover, working capital requirement is 2.5 crores, 5% of turnover is 0.5. This is margin actual prescribed, but available net working capital is 0.4. So whichever is higher means 5% of turnover only higher. So this is margin. 2.5 minus 5, 2 crores. For example, I will tell you, instead of that, here available net working capital is 0.70 crores. Available net working capital. So in this case, we consider this as a margin. So 2.50 minus 0.7, then it comes 1.80 only. So this is how we calculate 1.80. This is how we calculate under turnover method. 25% of the projected turnover is called as working capital requirement. Out of that, 5% of projected turnover is margin. And then comes your permissible bank finance. Working capital requirement minus margin. If available net working capital in the system is more, in such case, margin will be available net working capital. So accordingly, your permissible bank finance will be reduced. If NWC is more than required level, then permissible bank finance will come down. Right? This is turnover method. Now we go for second one, and applicability. Turnover method, whom it is applicable? MSME working capital limit up to 5 crores. Other than MSME, up to 2 crores. MSME working capital up to 5 crores. Other than MSME, up to 2 crores, it is applicable. Traders, merchants, etc. This is also other than MSME, so 2 crores applicable. And the current ratio for this prescribed is 1.25. Right? Next, another point here. However, borrowers can opt for either MPBF or cash budget system. Though they are eligible under this, they may opt. Then you have to, as per customer's request, we have to proceed. That's what Reserve Bank is telling. And second one is MPBF system, maximum permissible bank finance. Why I am showing calculations is, in exam also they are asking calculations. Simply by giving turnover of 10 crores and available net working capital 0.7 crore, they are asking what is permissible bank finance under turnover method. Like that they are asking. Similarly, MPBF system, maximum permissible bank finance system. Here also we will see how we will calculate MPBF system. Yes, sir. Here MPBF system calculation is first gross working capital. We see gross working capital is nothing but total current assets. Gross working capital minus, as per balance sheet we have to calculate this, less current liabilities excluding bank borrowings. Out of current liabilities, whatever it is there, current liabilities may sundry creditors will be there, bank borrowings will be there, and other creditors will be there. So out of that bank borrowings you exclude, remaining current liabilities you calculate. So that is taken here. 8 crores is other than bank borrowings, current liabilities may. Then coming 32, it is called as working capital gap. In earlier exam also, the question they are asking, what is working capital gap? Working capital gap is nothing but total current assets or gross working capital. Gross working capital minus current liabilities excluding bank borrowings. It is called as working capital gap. So The party's gross working capital this much. Already somebody is financing this much, 8 crores. So now what is the gap? 32 crores. This is how we arrive working capital gap. So out of this working capital gap, we will give some amount. Party has to bring some amount. Whatever party has to bring, that we call as a margin. So what is margin for this? Again, 25% of total current assets or gross working capital. 25% of gross working capital is margin. So 25% of 40 crores is 10 crores. This is margin. But here another column is there, just like earlier one, available net working capital in the system. As per balance sheet, we have arrived total current assets minus total current liabilities is equal to net working capital. So we have calculated here net working capital has come 11 crores. So which one we have to take margin? Either 25% of gross working capital or current assets or available net working capital. Whichever is higher is prescribed as margin. So now 11 is considered as a margin. So 32 minus 11, 21 crores. This is considered as maximum permissible bank finance, MPBF. That's why we call this as MPBF method, maximum permissible bank finance. Right? Now, here for MPBF finance applicability beyond turnover method, this MPBF is applicable up to 25 crores. Up to 25 crores. And beyond 25 crores, generally cash budget method is applicable. But if party opts less than 25 crores party only, but he says, sir, beyond 25 crores party, though he is eligible under cash budget method, if he opts for MPBF, then you have to proceed under MPBF only. Ultimately, borrower's ka choice of borrower, right? So limits over 25 crores can be assessed on the basis of MPBF system or cash budget system at the option of borrower. This is what continuously. And in options, Jagannath sir used to tell all options A, B, C, D. So they will give, what is that? You are sanctioning 20 crores to a, you are sanctioning 30 crores to a industrial unit working capital. Under which method you will finance? First, they will ask yes, turnover method. Second, MPBF. Third, cash budget. And fourth option, they will give either turnover, either MPBF or cash budget as per the option of borrower. So here, though it is eligible under cash budget method, but borrower's option is there for MPBF. So either MPBF or cash budget as per the option of borrower. So that should be the answer. Immediately don't study and yeah, it is there, cash budget method is there, about 25 crores, cash budget method is applicable. So in tickets, then we will solve, right? Third one is cash budget system. Cash budget system is otherwise called as deficit financing. What deficit here? Deficit between cash inflows and cash outflows. That deficit we are financing, that is why cash budget system is called as deficit financing. Okay. Working capital limits, they are assessed based on projected cash flow and estimated cash deficit. Suppose in this month, party is getting 10 crores cash inflows and cash outflows are there 15 crores. So now gap is 5 crores. Next month also we will calculate. Like that, all 12 months you calculate cumulative cash deficit kitna hai. So this month 5 crores, next month 10 crores, next month 15 crores. So cumulative is 30 crores. This you fix, and again sublimits also you can fix. Right? This is how we calculate cash budget system. So borrowers seeking or enjoying fund-based credit facilities of over 25 crores eligibility. And specific industries, seasonal industries, in cash budget method, several times asked question is this one only. Applicability for specific industries are seasonal activities such as software, construction, tea, sugar. Now NBFCs also you have to do under MPP, the cash budget system only, NBFCs also. Okay, wherever for valid reasons, if the borrower opts to avail working capital under MPBF, yes, you have to. That's what earlier we have discussed. And bank shall finance discounted net cash flow. Suppose here what this is, earlier this system was not there. About 5-6 years back, bank has introduced. Suppose we have installed our POS machine in a big shop. We have installed. There approximately every month we are getting some 1 crore rupee out of our PM machine, 1 crore. So here every month he is getting 1 crore. If for annum it is 12 crores he will receive. Such cash flows we calculate. So here 12 crores he is receiving, 25% margin you reduce. So 9 crores we will fix him term loan. This is basing on anticipated cash flows. So here we can sanction term loan also against expected cash flows with repayment of 3 years maximum. This has come subsequently, right? Next, for NBFCs, of course, cash budget method only we follow. Gold card scheme for exporters, standby credit limit. Gold card scheme for exporters. It is to facilitate urgent credit needs, 20% over and above assessed limits. What we do is, at the time of assessment of this gold card exporters, we assess and 20% extra we sanction and keep. It is called standby credit. We sanction but not disburse. This will be standby. Whenever party requires for urgent needs, yes, we release this 20%. It is for a maximum 2 times only in a year, not exceeding 60 to 90 days at a time. Just like your ad hoc, nothing but standby. Right? Next, lending on guarantee issued by other banks or financial institutions. This is one point I will tell you. Our party will come. He says, sir, I am having account with State Bank of India. And the State Bank of India is guaranteeing me, giving me guarantee. Against that guarantee, you give me loan. We can ask very well. When State Bank of India, instead of giving guarantee, it can directly sanction loan. Because giving guarantee means they are believing you. And they are satisfied with your service. So that's why they are giving guarantee. Why can't they sanction loan also? Here problems comes. In some cases, some sectors, they will have prudential exposure, maximum this much amount only they can give for particular sectors. If it is exceeding, earlier we have seen subprime people, near prime people, we cannot sanction more than 10% of total retail portfolio. So if such cases will come, their threshold limit is reaching already. So fund-based they cannot sanction. They don't want to lose that party. In such cases, what happens is they will give, Are Baba, I will give you guarantee. You take this guarantee and raise fund-based limit from some other bank. This lending against guarantees issued by other banks, that case will arise like this. So there, the condition is that the borrower should have satisfactory dealings with us for at least 3 years. Here, satisfactory dealings means he may have current account or he may have loans also, doesn't matter. Because multiple banking arrangement, consortium, etc., is also applicable. So the guaranteeing bank, whichever it is giving a guarantee, that bank should have fund-based limits at least to the extent of 10%. I will tell you, party has brought guarantee for 10 crores here to our bank. He says, sir, you give 10 crores, I brought guarantee. Okay, 3 years satisfactory dealings are there. Next condition is, for 10 crores, bank has given guarantee. That means, in the 10%, how much? 1 crore. So, party should enjoy fund-based limits at least 1 crore with that bank, State Bank. Then only we will finance. So, guaranteeing bank should have at least 10% of the guaranteed amount as fund-based limits. Then only. So these two conditions, it is also recalled question. Earlier it has come. Right? Next, liquidity and current ratio norms. Liquidity and current ratio norms. So the benchmark current ratio is minimum 1.33 for your cash budget method and also your MPBF. It is 1.33 and 1.25 in case of your turnover method. So this is prescribed benchmark current ratio. And these benchmark current ratios are not applicable for working capital of schools, colleges, hospitals, nursing homes, hotels and restaurants, service providers, infra projects and plantations. For them, it is not applicable, right? And the current ratio, benchmark current ratio, not applicable for sugar industry. For this also, this is exempted. And bank may obtain quarterly cash flow statements in respect of borrowers having working capital limits of 550 crores and above. So wherever parties are enjoying with us 50 crores and above OCC or OD, in such cases, what we do, we call cash flow statements from our borrowers for monitoring cash flows. Whether current ratio is as per norms or not, that also we will verify. And this another ASM, this is 2 times recalled question. About 3-4 years back, again, RBI has introduced. What RBI has introduced is, any party, if they are enjoying 250 crores and above from banking system entire, not only from our bank, from different banks, if a borrower is enjoying 250 crores and above from banking system, in such cases, their cash flows, the party company ka cash flows are borrowers' cash flows, it is to be monitored by ASM, Agency for Special Monitoring. These are all chartered accountants. They will have firm. So this firm, they will send some chartered accountants, and those people will assess their cash flows. They have to submit cash flow statement. That will be monitored, where this cash is coming and where this cash is going. So it is one of the monitoring tool. So here 2 points here. Cutoff point is parties enjoying 250 crores and above, parties enjoying, they have to, their cash flows are to be monitored by Agency for Specialized Monitoring. External chartered accountants, they have to monitor. And for them, fees is there again. Fees is there. If party is enjoying 500 crores, up to 500 crores, such cases, 5 lakh rupees plus GST. If party is enjoying more than 500 crores, such case 8 lakhs plus GST. Annual charges, we have to pay quarterly, proportionately quarterly. So there are charges for that chartered accountant who are all monitoring their cash flows. We will pay. Right. Quick ratio. This earlier also Jagannath sir told quick ratio. Ministry of Finance has given guidelines to banks stating that you calculate quick ratio also while sanctioning loans. You see whether quick ratio also it is there sufficiently or not. For that, applicability is quick ratio. Here, MSME borrowers 10 crores and above, and other than MSME borrowers 50 crores and above, if they are enjoying, in such cases, quick ratio also we have to verify. While sanctioning, we are giving so many parameters: debt equity ratio, debt service coverage ratio, fixed assets coverage ratio, like that. So this ratio also you see while sanctioning. This is what the Ministry of Finance has told. Then it is introduced for this non-MSE 50 crores and above 50 crores, and the SME above 10 crores. They have given various ratios starting from 0.61 to 0.93. This is desirable quick ratio. What is this quick ratio again? Current assets minus inventory divided by current liabilities. Normally current ratio 1.33. So minus inventory we have to calculate. That is why it is always less than 1 only. Because inventory you are removing. Right? Next, compliance to sanction terms and conditions. Now NF 482. Now it is online also. It has come recently. They have seen circular. Fixation of time schedule for working capital. Generally, for working capital limits, OD, OCC, we fix 12 months only. Earlier, basing on risk, it was 12 months, 15 months, 18 months, like that it was there. And for SME, 24 months also were there. Now, commonly, uniformly, it is 12 months only, irrespective of risk rating. And category, what are all the excluded categories? Staff OD, GL OD, crop loan, KCC, and other schematic lending like doctor choice, etc. Next, putting through EMT mortgage transactions. What is this EMT transaction? At the time of sanctioning loan, we prescribe, yes, this is the period given for you to create mortgage. Because we are giving loan against security of some property, and you have to create mortgage within this period, like that we give time. Suppose for any difficult reason, party is not in a position to complete mortgage. In such cases, first and second extension, maximum 6 months, concerned sanctioning authority can extend. Maximum extends. 2 extensions, but maximum 6 months, both put together. And third extension onwards, it will be by next higher authority up to CO powers. Okay. And the concerned sanctioning authority at HO for HO power accounts. Yes. Sir, just 5 minutes, we will take break. Yes, Krishnan sir. 5 minutes we take break because afternoon session. That's why I also thought there 100% we have to take, right? Next, delegation of powers while taking any fresh exposure or additional exposure under gems and jewelry. Gems and jewelry. Here, renewal by respective sanctioning authority. Renewal with enhancement, low risk up to normal risk, it is by respective sanctioning authority only. But moderate risk, it is CGM, GMHO, CAC and above. If it is a fresh proposal, up to 5 crores lower and normal risk, the COA, they can sanction. If it is a moderate risk, above 5 crores, low risk, normal risk and moderate risk, HO, GMHO, CSC. For discoms, that means electricity board, discoms, working capital shall be restricted to 25% of total revenue as per audited balance sheets. Here, basing on revenue 25%, normally turnover method 25% is working capital requirement, 5% margin. That means 20% of your turnover is working capital. But for discoms, 25% we are giving as working capital, not 20%. And similarly, in case of Genco and Transco, working capital is restricted to 50% of total revenue as per ABS. Again, total working capital is restricted to 50% of the total revenue. So here it will go up to 50% because some restructured, etc., it was there earlier. We need not worry about those things. Now, takeover of borrowal accounts. I think our Jagannath sir has covered some of the aspects. That is why only important aspects I will cover in this takeover. I know. If party has closed with his own sources and coming and approaching after 3 months, it is not considered as takeover. Similarly, if agricultural loans, party has closed with his own resources and approaching us for loan after 10 days. Here it is not considered as takeover. Normal norms only applicable. You know? And next one is up to BBB and above. We will accept. In case of MSME, BB means it is a moderate risk. Normally, up to normal risk we will accept, but MSME moderate risk because we are considering up to moderate risk as investment grade. Up to moderate risk as investment grade. So BB is considered as moderate risk, it is investment grade. MSME we accept. For others, it is BBB, normal risk. Okay, next earning profit for 3 years. Previous 1 year not restructured, not appeared in SMA 2 18 months as Jagannath sir told. Last year it was 12 months. Now they have enhanced. So during previous year, it has not appeared in SMA 2 during 18 months, not 1 year. That is change current year. Important. And general guidelines, the account should have been in the books of the transfer book minimum 1 year, 6 months in case of low risk and rated borrower. Manufacturing unit, if it is a manufacturing unit, at least 1 year it should have completed in manufacturing. And the repayment track record, 6 months we have to satisfy. And shifting of accounts from other banks shall not be more than one occasion during last 5 years. And recently they have given leverage also. What is that leverage? Earlier, if party was earlier with us and subsequently it has gone, means for them, we are not considering this minimum period, we are not considering. But now it is applicable for them also. Party who left us, for them also now it is 2 years or 1 year as a case that is applicable. Next, audited financials for 3 years, we have to obtain and verify with ROC, current ratio compulsory as per prescribed norms. And MSME up to 1, it is recalled question. MSME for takeover, what is current ratio permitted? It is up to 1, including 1, it is permitted. Even exam they have given including 1. Right? Debt equity ratio generally 2:1 and relaxation 3:1 or 4:1. Pass sheet for 1 year term loans and 6 months for working capital. For term loans, in case of term loans, if cost overrun or time overrun, what is cost overrun? Cost overrun means suppose 100 crores project. and it has exceeded by 20 crores. Now it has become 120 crores. So cost overrun is 20%. It is not eligible for takeover. Time overrun. You say in 2 years, entire construction will be completed and the commercial operations, they will continue. We call COD date, commercial operation date, or DCCO. DCCO we call, otherwise also. That means commencement of commercial operations, date of commencement of commercial operations. 2 years we have prescribed, but it has taken another 6 months, 2.5 years it has become. In such case, it is exceeded by 25%. So not eligible for takeover. The cost overrun or time overrun will be within 15%, not more than 15%. Right? Next. Repayment period. Normally, whatever repayment period left over in other bank, same repayment period we have to give. We should not extend. Why we should not extend means, as per Reserve Bank of India, if you are extending repayment period or if you are changing rate of interest, it is considered as restructuring, and you have to classify standard account as non-performing asset on restructuring. Immediately, it should become NPA on restructuring. So two aspects Reserve Bank has told: extension of period or your change in terms and conditions like rate of interest, installment, etc. So this is considered as a restructuring. That is why here what they say is, you should not extend repayment period at the time of takeover. Only exception given is lease rent discounting, your Canara rent. There up to maximum permissible in that scheme is 180 months. So in leftover period, if it is any gap in 180 months, up to that gap you can fill it. Not more than 180 months again total. Suppose in earlier bank, already party has kept for 60 months. Now in scheme leftover is 120 months. But as per previous bank sanction, another 100 months only leftover period is there. So here you can extend for another 20 months because your scheme permitting up to 180 months. This is how LRD, lease rent discounting, maximum up to 180 months. Within 180 months, we can permit extension. In other cases, no question of change in repayment tenure. Security coverage, whatever it is there, compulsorily party has to bring. In takeover with enhancement, another question, takeover with enhancement. Security coverage in the form of land and building, our own bank deposits, NSC, KVP, insurance policy, etc., not less than 50% of the entire exposure, including enhancement amounts. This is in case of takeover with enhancement. So minimum 50% security should be there. In that again, vacant land not more than 50%. In that collateral security. If enhancement is more than 25%, sanctioned by next higher authority. Enhancement. And HO, it is same authority they can sanction. Next, fresh term loans are proposed for expansion during takeover, respective sanctioning authority. Apart from this, fresh term loans, yes, respective sanctioning authority, they can sanction. Expansion and also concession in rate of interest. Here two leverages and service charges. Then two leverages means next higher authority up to CO head CSC. Okay. Next, proposal with enhancement. If collateral is more than 100% of exposure, including enhancements, at least 15% of collateral should be in the form of commercial or residential properties. This norm 15% minimum commercial or residential properties for several loans it is coming. So you should keep in mind. Next, stock audit. It is to be conducted. Normally at the time of stock audit to be completed, but waiver is there in two occasions. One is waiver of stock audit up to 10 crores provided previous bank's stock audit report is not older than 6 months. If it is older than 6 months, you can give for up to 3 crore parties, you can give waiver of stock audit. If it is less than 6 months, up to 10 crore parties, you can give waiver of stock audit. But in both cases, 3 months stock statement, you have to obtain. Previous 3 months from other bank, you have to obtain and scrutinize. In case of MSME, up to 1 crore, CO head may permit waiver of stock statement and stock audit, etc., if 125% security is available. And sanction communication of last 3 years. In case of agriculture, 1 year, it is to be verified. Takeover from bank where any of our whole-time director worked earlier, sanctioned by HOCAC and above. This already our Sir Jagannath sir has discussed. Just 1 minute I will take up. Only 1 minute. Policy and takeover retail loans. Yeah, retail loans. Here, prior to takeover, you should have minimum 1 year with the transferring bank and prompt repayment at least in 6 months during previous 1 year. That also CRG3, moderate risk, because up to moderate risk we consider as a investment grade. So up to that we can accept. And not appeared in SMA during last 18 months. Here also for 12 months it is transferred to change it to 18 months as per CRILCAR CIR report. Loans where projects are not completed and not fully disbursed, yet not to take over. And lease discount, as I told you, up to 180 months we can extend. That is extension of period. And valid EMT should be created within 30 days. This is regarding retail loans takeover. Fresh facilities to OTS already SAR has covered, so I will skip it. Restrictions on lending. Restrictions. One is no loans against our own shares. That is Section 20 of Banking Regulation Act. And similarly, we should not provide loans to buyback of their own shares. This is another restriction. And this point, Section 19(2), several times it has appeared in exams. BR Act 19, Section 19(2), what says is either pledgee or mortgagee or absolute owner, etc., etc. We should not sanction loans to parties against shares or holding that company shares exceeding 30% of that company shares or 30% of our own paid up capital and reserves, whichever is less. Holding shares in that companies normally. What happens is, earlier I told you in capital market may maximum 40% is exposure ceiling. Out of that 20% maximum we can invest directly in shares. So here your investment in shares of that company or your investment in your finance against shares of that company, all put together should not exceed 30% of that company's capital or 30% of our capital and reserves. This is Section 19(2) of BR Act. Several times this question appeared. So Section 19(3), what it says is, any of our director or manager person, our directors earlier they worked in that or they have some interest in that company, then don't sanction. Selective credit control. What is the selective credit control means? Reserve Bank has come up some essential commodities like rice, sugar. These are essential commodities. If you sanction loans liberally, traders may buy huge quantum with your finance and keep in godowns. What happens? It will not come to open market and scarcity of essential commodities will arise. So don't finance liberally to those essential commodities so that parties, they will not keep in godowns. If they want to keep in godowns, they have to pay their own money, not borrowed money. So if they have money, otherwise they can't. This is called selective credit control. On essential commodities, some restrictions. So at present, what they say is, in case of advances against levy sugar, only now levy sugar only essential commodities, our control may, it is there in SSC. So their minimum margin 10%. Levy sugar, normally it is in government hands, we can finance up to full, but there also minimum margin 10% we are applying. Even open sugar, then it's meant for market. There also previous 30 days average rate we take while permitting drawing power. Right? Next, no loans against certificate of deposits. Normally, banks and financial companies will issue up to 1 year, no loans. And FDRs of other banks, no loans against FDRs of other banks. No loans against partly paid shares also. right? Next, no loans against primary security of shares. As I told you, other than individuals, there is no question. Partnership, proprietorship, companies against primary security, but you can keep as collateral security, right? For purchase of gold, no loans, but while financing up to 50 grams sold by banks, you can consider as security, right? Next, gold exchange traded funds. These are in commodity market, they are traded. So against those funds, no. Against gold mutual funds also, no loans. And if government is constructing buildings for their own use, there we should not finance. Right? And ozone depleting substances like ACs and some problems are there. Some chemicals or some fumes, gases, they spoil ozone in the atmosphere. So such chemical emitting or such gas emitting companies don't finance. This is the restriction. And IVP, KVP, etc. acquiring, don't give. Banks should not extend bridge loans. What is this bridge loans? Some amount is expected to our borrower. Against that amount, we are sanctioning. Just like your Canada, what is that rent, Canada rent. You are expecting some rents. Against that, we are financing. Similarly, if some amounts are receivable from others, like a party is going for public issue, there you are expecting some amount. Against public issue, you can give bridge loans, but government subsidies, etc., receivables will be there. Against that receivables from government in the form of subsidies, don't give loan. That is what, no bridge loan against receivables from central government by way of subsidies or refunds, etc. But others like expected equity flows or public issues, against that you can give. Okay. Next, ideas, Indian depository receipts. So some foreign company, they want to raise amount in Indian market. So they keep some shares with one depository. That depository will issue shares, the bonds in India. They are called as Indian depository receipt. Just like shares, you can buy and sell. So against them, no question of loans. Because this money will go to abroad. Already this amount, whatever that ideas are there, that money will go to foreign company. Next. Variations, already sir has discussed this today only. Credit delivery, these are days only. Within how many days you have to dispose of loans, etc. Right? These are all credit delivery. We need not worry about this. But one question they are asking, at least 1 to 2, 2 to 3 level, they are asking. Gold card scheme for exporters. This is also days 25, 15, and 7. Yes. Charges, today sir has discussed this all, what are all the penalties. So I will skip and go for other, because today only our Jagannath sir has discussed all these things. Commitment charges, delayed payments, priority sector, QoS, HOS, quarterly operating system and half yearly, this discussed sir already, I heard. That is why drawings in excess of sanction limit, including OCC account, including WC, 2% work overdone. Devolved liabilities. Annual financial statements. If they are not submitting by 31st October, 2% penalty. I'll discuss this. Non-submission of renewal papers before 1 month. Sir has discussed. This is current year very important because it has come about 1.5 years ago only. Non-construction of house. Penalty for account slipping, TNPA already over. Enabling mechanism. When MSMED Act has come in 2006, October 2nd onwards, MSMED Act has come into existence. In MSMED Act, what it says is, banks, while financing working capital loans of 10 crores and above to corporates. That means if you are financing 10 crores and above working capital loan to a corporate, for them, you fix some sublimit towards repayment to MSMEs. That means that corporate may be taking some supplies from MS small units. They may be taking some supplies. If this big corporate neglects repayment to small units, the small units will die because no working capital for them. Already this is a big corporate. They cannot question that corporate. Otherwise, problem for them. So it's to protect the interest of small SMEs, what reserve the MSMED Act says is, if you are financing 10 crores and above to a corporate as working capital, you fix sublimits towards repayment to MSCs, micro and small units, who are supplying material to this corporate. If the corporate says, sir, I don't have any small unit supply, if it is evidenced, then you give full limit, no issue. But if he is taking supplies from small units, in such case, you fix a separate sublimit towards repayment to MSCs. This is called enabling mechanism, MSMED Act. Duration of working capital, already 12 months it has come. Extension 2 times, at a time 3 times maximum, up to moderate risk. High risk, it is only 1 time, 2 months only, normal. Revalidation of working capital. Normally, working capital limits sanction validity. How much? STCL and corporate loan, generally 3 months permitted. If it is a clean loan, 1 month only. Because clean STCL, unsecured STCL, we have seen 1 month, within 1 month they have to avail. Otherwise, it will be lapsed. And again, you have to revalidate that sanction. Right? Working capital validity is 3 months. Afterwards, again 3 months you can revalidate. Term loans validity 6 months. Ad hoc credit facility 15 days validity. Then subsequently no revalidation. Credit facility sanctioned under consortium lending arrangement where our bank is a leader or member up to 6 months validity. And validity period of sanction of working capital and term loan to NBFC 3 months. This is separate new. Recently it has come. So it is important for current exam. 3 months for NBFC, whether working capital or term loan. Right? Next. What happens in case of consortium or JLA? There will be more than one bank. It will be there. And party has executed loan papers. Normally, executed loan papers means it is implied that party has availed loan. That is why now bank also given guidelines on the day of executing loan papers, you have to open loan account. Bank has given guidelines. Because it is implied that party has signed loan papers means it is availed. So similarly, in case of consortium or JLA, if party has entered into already executed all loan papers, but not availed finance from any of the banks, though he has executed loan papers, but not availed any bank for period of 12 months. In such cases, you have to revalidate again. This is sanctioning authority say revalidate, you have to do. Right? Next, in case of consortium accounts, the sanctioning authority at the time of sanction may stipulate suitable validity period of 6 months. Already we have seen here consortium up to 6 months we have given from the date of sanction. But at the time of financial closure, what is financial closure? Financial closure means party has tied up with all banks. That means party has received sanction letters from all banks who are financing him. Say he need 1,000 crores finance from 4 banks, each bank 250 crores. All 4 banks have given sanction letters. Then we call it as financial closure. So at the time of financial closure, normally we give 6 months time. In case of non-achievement of financial closure, some other bank has not given sanction letter. If all banks are given, no issue. One bank has not given. So financial closure is not done. In such cases, another 6 months you have to extend. So here 6 months in a normal sanction period. If any due to problem financial closure is not done, then another 6 months you have to extend. These are guidelines regarding period of your sanctions. And review cum holding operations. It is also just like extension of your tenability of OCC. Here, what happens is standard assets, NPA and not market for recovery. Such accounts we permit holding on operations. Why we permit? Sometimes problems came in unit not due to party's failure. It is not in the hands of promoter. External climate, for example, COVID. Though parties have not done anything, the business has not run because lock-in period, longer periods. In such conditions, if you say that repayment have not come and we will go for recovery, we will make it NPA and go for recovery. In such cases, party will suffer, unit will die. So to protect their interest, holding on operations have come. What is this holding on operations? When you are permitting holding on operations, the liability will be squeezed. That means at the time of permitting holding operations, OCC, it is liability of 1 crore. You permit operations subsequently in that OCC, but at any point of time, liability should not exceed 1 crore. That is what squeezing of liability. And holding on operations we will permit, but it should not exceed liability 1 crore. And here also maximum 6 months we will permit holding on operations. Next, rejection of credit proposals, SC/ST beneficiaries, next higher authority, government sponsored schemes. Here you have to record in the register so that next official who is visiting branches, they will verify. MSME, it is concurrence of next higher authority. You have to keep in mind concurrence of next higher authority, rejection by next higher authority. In case of SC/ST beneficiaries, rejection by next higher authority. That means you have to forward entire loan, appraisal, etc. to next higher authority, and they only take decision and reject from their end. Branch is rejecting through higher authorities. Whereas concurrence means with consent. Yes, you can tell them, sir, we are rejecting because of this. Okay, over. This is concurrence of higher authority and by next higher authority. Difference. Educational loans, concurrence of next higher authority. Export credit, we can reject but report to CMD through concerned wings. Export credit. These are all recalled questions. That's why I'm just. Next, whatever rejections are there, you have to record that in your package. Now NB 139 online package is there. There you have to record so that higher authorities will review. Okay. Now Janasamartha portal has come. So any applications received through Janasamartha application, here also you should not reject, and next higher authority it is to be rejected. Right? Of course, conversion of limits, non-fund based to fund based, only for your purchase of raw material we will allow. LC to advance payment guarantee, both we can convert as fund based limits, LC limits, but only for your raw material purchases, stocks purchasing. Post shipment to pre-shipment not permitted, because post shipment means bill financing. Pre-shipment means packing credit, your OCC. Bills to OCC not permitted, but OCC to bills permitted. Right? Secured limits are not converted to clean limits. Right? The general guidance. One-way conversion LC to BG for purchase of raw materials. So conversion is for only for raw materials only, permissible. Exit policy. If some account is not good, we don't want this account, we will get rid of this account. This is exit policy. Send him out. But how to send? We says, Baba, we will give you NOC. You go and approach some other bank. This is what exit. When it will be exited? Persisting irregularities, continuously irregularities are there. Frequent ad hoc, no stop, drawing power not there and limit is exceeding. Failure of restructuring or rehabilitation efforts more than 2 times in 3 years. Restructuring efforts are failed. So no question of restructuring now. Why it is failed? Maybe security is not covered, because about 25 lakhs normally security coverage should be there. So other parameters also they are not meeting. Next, borrowers of consortium, MBA, JLA rated a high risk. And willful defaulters by the borrower group. Suppose any willful defaulters are there in the borrower group, you have to maintain higher provisioning, 5% provisioning. That is another problem. So the activity of the borrower has become uneconomical, no profits. Financial indiscipline. Steep downgradation in risk rating, more than 2 notches, not less than 2 notches. No-go rated companies under CBPR pricing. These are all exit policy ka parameters. So in such cases, we will send the party out to some other banks. Somebody take over, okay, well and good. Next, personal guarantees. When you have to obtain, private limited companies, LLP, registered partnership, compulsorily you have to obtain. And 5 crores and above Aadhaar number, already I told you. And 5 crores and above CS certified net worth statement with UDIN number of guarantors. This is one aspect. If you are accepting guarantor, third party guarantee, his net worth should be certified by chartered accountant if exposure is 5 crores and above, exceeding 5 crores. Right? Next, apart from that, if exceeding 5 crores, half yearly confirmation from the guarantors letter is to be obtained. At the time of giving guarantee, whatever assets are there, still those assets are available with me. So that letter he has to give once in 6 months. You have to accept. If your exposure is exceeding 5 crores. And any promoter director, they cannot give personal guarantee more than 5 times of the net worth. This is another aspect, unhedged foreign currency exposure of corporates. What is this unhedged foreign currency exposure means? Suppose party is importing some imports, some material. For that, he has to pay foreign currency. He has to pay in foreign currency. And some other commitments are there, forward contracts, etc. So there also commitments will be there. For them, what we have to do, whatever foreign currency outgoing is there, parties, it has to be covered with hedging, forward contracts, hedging, etc. Or if anybody is having natural hedging means he is exporting material, getting foreign currency. Similarly, he is importing some material that he has to pay foreign currency. So foreign currency outward is there, inward is also there. Their natural hedge we call. In such cases, he need not worry. Any unhedged foreign currency is there, that is risky. Why it is risky? Suppose now price movement is very heavy. Because of this price movement, party may not meet his commitment if it still goes up at the time of payment. So if he fails to pay foreign currency within that time, again problem. So what Reserve Bank is telling is, any corporate, if there is any foreign currency exposure is there, that exposure is to be hedged by forward contracts, etc. If it is not hedging, then you apply penalty. This is what Reserve Bank says. Okay. So now all clients are required to submit their unhedged foreign currency exposure, UFHE, on quarterly basis. They have to give how much foreign currency is not hedged. Foreign currency exposure, they have to give quarterly statement in plain paper, no issue. But once in a year, audited statement they have to give once in a year, yearly. Right? For computing foreign currency exposure, maturity or having cash flows over the period of next 5 years, it will be considered. And suppose if anybody is not hedging, then it is incremental provisioning and capital requirement for that. And again, for calculation of this incremental provision, it is up to 50 crore rupees, exposure up to 50 crore rupees. Instead of calculating all these calculations, what Reserve Bank is telling is just 10 BPS provisioning you enhance. Suppose 0.4% you are keeping standard asset provisioning. If such unhedged foreign currency exposure is there, instead of 0.4% provisioning for standard asset, you keep 0.5% provisioning, because 10 BPS you have to enhance. 10 BPS means 0.1%. You enhance. This is what Reserve Bank is telling, incremental provisioning. And for above 50 crores, you have to calculate through this principle potential loss by EBID. Potential loss means due to unhedged foreign currency, how much loss is expected. That is potential loss divided by EBID, earnings before interest and depreciation. EBID. So you have to calculate for more than 50 crores, and basing on this EBID ratio, if this potential loss is more than 75% in EBID ratio, then you have to keep incremental provisioning 20 BPS to 80 BPS. That means 0.2 to 0.8% incremental provisioning. They have given so many steps, 0.1, 0.2 like that. And 25% increase in risk weight. 25%. Suppose it is a AAA rated corporate. AAA rated 50% risk weight. Since unhedged foreign currency is there, you apply 75% risk weight, not 50%. So this is the effect of unhedged foreign currency exposure, not covered by your forward contracts or hedging. Right? Okay. For waiver, you are telling this BPS plus additional provisioning. If you want to waive this hedging foreign currency car, so party has to maintain at least 25% hedging should be there, minimum. It is for LR1 and LR2. And for LR3 parties, minimum 50% hedging should be there. Then it can be waived for remaining portion. Right? Or where the borrower is willing to offer 10% margin or additional collateral comfort. In such cases also, we can waive this unhedged foreign currency exposure ka penalty, whatever it is there. Right? But in case any eligible entity is not submitting the required data to our bank, because I told you once in a quarter they have to give data. If no exposure is there, simply they can give yes, no exposure. And once in a year, at the end of March, they have to give audited. If they are not submitting the data, 1% penal interest above applicable rate of interest. Right? Legal audit of title deeds. It is applicable for 5 crores and above. And after 3 years from sanction. And subsequently, after a gap of 3 years, preferably with RBIA inspection. And maximum gap between two auditors is 36 months to 54 months. Right? Next one, opening of cash grant or OD facility. Suppose the party is having 5 crores term loan with us, no OD OCC, 5 crores. Since it is below up to 5 crores, he can open in any bank and avail OD OCC facility. But if it is more than 5 crores, OD account is to be opened by a bank where at least more than 10% exposure is there. Suppose party is 100 crores, limits are there. In some bank, 15 crores is there, remaining all banks 5, 6 like that. So this 15 crores bank, whatever it is there, it's more than 10% of his exposure. So they have to open OD. If it is a MBA, whoever is having higher stake, they have to open OD. This is the guideline regarding opening of OD. ECAI, External Credit Assessment Institutions, External Credit Rating. It is compulsory for above 25 crores because up to 25 crores, our CIRM will take care. Above 25 crores, it is compulsorily, we have to do external rating. Right? For risk weighting purpose, capital calculation purpose, it is compulsory. And basing on rating, I told you risk weight. AAA, if it is a AAA, 20%, AA, 30%, EA, 50% like that. It is given by Reserve Bank of India under standardized approach. Right? Domestic credit rating agencies are CARE, CRISIL, Fitch, ICRA, Acute, earliest Infomeris, and Brickworks last year they have removed in 2022. Again, it is added up to 250 crores. Now you can accept Brickworks also. But exposure maximum 250 crores only. Beyond that, don't accept. The latest one, important for current exam, Brickwork amount ceiling. Right? Next. International rating agencies. Sometimes what happened is in 1 to 2, they are asking, identify which is odd man out. Like ABCD, they will give 3 domestic rating agencies and 1 international rating agency they will give. Odd man out is international rating agency. You have to identify. Like that questions they will ask. So Fitch ratings, Moody's, Standard and Poor. These 3 are international rating agencies. Right? In respect of all ECAI rated accounts, credit rating press release, yes, this is one aspect. 2 years back, Reserve Bank of India has given guideline. External rating, it is done by, say, for example, CARE has done external rating of a borrower. What it has to do, after completion of this external rating, they have to give in press release that so-and-so company has got this much rating. And they are having exposure with so-and-so bank, this much is exposure. So these details they have to disclose in press release. If they are not disclosing such things, then it is treated as unrated. This is what Reserve Bank has told. Right? And what it is, it attracts 100% to 150%. Again, when it is 100%, it is up to 100 crores. Yes, 100% risk weight. More than 200 crores, 150% risk weight. In between 100 to 200 crores, what happened is earlier rated, now it is unrated. In such cases, 150% risk weight. Otherwise, 100% risk weight for that. Right? Right. Then timelines for obtaining is a greenfield project, means new party. Now started construction of this industry. That is greenfield. From 0 onwards, it will, so ground level to it will start greenfield. So in such cases, within 6 months from the date of disbursement, party has to submit this audited balance sheet and complete this ratings. If balance sheet is not there, what happens in construction is going on? At the time, they will have PIPR, Project Implementation Progress Report, or LIE report, Lender's Independent Engineer report. So basing on these reports, they can do rating. Right? If party has already applied for external rating, then 3 months from the date of sanction, they have to submit. This is timeline for submitting. And moreover, external credit rating waiver is permitted by ED and above authorities. Below ED powers, nobody can waive obtention of ECAI for loans above 25 crores. Compulsory. If you want to waive for above 25 crores party, then only ED and above authorities only can permit, not below authorities. Right? Next, in case external, okay, already we had it. In case externally unrated borrowers with exposure above 24 crores to 100 crores, additional 0.5%. I think Jagannath sir has already discussed earlier, it was 0.25. Now it is enhanced to 0.5%. And for exposures above 100 crores, 1% penalty. Right? Cross default, monitoring of cross default and financial covenants. Default with one lender may trigger default with another lender. Earlier we have seen in groups, group covenant we have seen in a balance sheet, etc. Similar to that, this also cross default. Party is enjoying limits with 4 banks. In one bank account has become NPA means other banks also likely to become NPA. Right? And considered as a cross default if it is not cured within 30 days. Suppose irregularities say then it is there, are there in one bank. If it is not repaid within time, within 30 days, if it is not regularized, then it may trigger to other banks also. So this is to monitor financial discipline among the group. It is monitored quarterly through CRILC reports and CAC reports. CRILC reports are 5 crores and above. Normally, every week they will be giving reports. So through that you can watch. Or CIC report. The guidelines are applicable for listed corporates with exposure 50 crores and above, listed MSME 1 crore and above. This is the recalled question. Monitoring of cross default is applicable to corporates 50 crores and above, listed corporates, and listed MSMEs 1 crore and above. It is applicable. P&L covenants, balance sheet, profit and loss covenants, net sales, net profit ratio, interest coverage ratio. Similarly, balance sheet covenants, that also will come next. Okay. So these are to be monitored quarterly. P&L covenants, it is to be monitored quarterly. Balance sheet covenants, they are to be monitored yearly. What is balance sheet covenants? TOL is to TNW, debt equity ratio, current ratio, etc. They are to be monitored yearly. How they will monitor? If there is any variation in more than 10%, that means at the time of sanction, whatever levels they might have given in a debt equity ratio this much, debt service coverage ratio this much, current ratio this much, like that they have given. And now current financials varies more than 10%. So it is breach of covenants. Then we have to monitor closely. Right? In case where the account is taken over by other bank, concessions or rate of interest charges extended for last 1 year to be recovered. Suppose if one of our borrowal account is taken over by other bank, whatever we have given concessions during previous 1 year, they are to be recovered before closure and transferred to other banks. And as per Companies Act 2013, no holding company other than banking, insurance, etc., they have got more than 2 layers of subsidiaries. More than 2 layers means now Canara Bank is having subsidiaries. Canara Bank is having Canfine Homes Limited. That is one subsidiary. Canfine Homes, again, it cannot form another subsidiary below that. This is what. Consortium, I told you, prudential norms, it is individual banks recovery, already it has covered. Guidelines on periodicity and participation of consortium meetings. Consortium meetings, normally we have to attend. And who has to attend? These guidelines are given. Where we are leader, in such a case, for any important decisions are to be taken and our exposure is 25 crores and above. In such cases, GM of circle or CGM of circle, they have to attend. Because we are leader, we have to take decisions. And DGM of circle for limits below 25 crores. If limits are below 25 crores and we are leaders, then DGM has to attend consortium meeting. And for them, branch in charge compulsorily, they have to attend along with either GM or DGM. If we are member bank, we are not leader. In such cases, DM of circle along with branch in charge, it is sufficient because member banks, they need not take all decisions. Only leader only will take and others subsequently with sanctions. Next, routine meetings. Once in a quarter, normally routine meetings will be conducted. No important messages are there. They call as routine meetings. Only exchange of information, if it is general tendency, they will discuss. In such cases, attendance by branch in charge, if scale 4 or 5 is there, he will attend. If branch is headed by non-executive, up to scale 3, somebody is heading. In such case, one executive from circle along with branch in charge. So this consortium meetings we have to attend. And we are leaders. Consortium meeting is over. Within 3 days, we have to prepare minutes of the meeting and circulate among all members. If some other bank is leader, we have to collect minutes within 3 days and forward to our reviewing authorities, next higher authorities. Right? Certificates given by third party entities, chartered accountants, engineers, who will be getting certificates. So, need for independent due diligence. What we have to do in such cases, third party entities, if they are submitting, then particularly we should communicate as far as possible directly with them, with TP, third party entities. And another one is chartered accountant, they will have UDIN number, the UDIN portal. In that, we have to verify. Some chartered accountant has given balance sheet or some other certificate he has given. In such cases, you have to verify ICAI website with UDIN number of this director, you have to verify. Right? Next, EC, this is another new aspect. Periodical obtention of encumbrance certificate in respect of properties mortgaged to bank. It is a new one. It is important for current also. What is this? Within 36 months from the date of creation of mortgage. First, at the time of creation of mortgage, party will submit. And further EC also, till completion of mortgage process, he will submit. Afterwards, 36 months. Within 36 months, you have to obtain EC. And for accounts where legal audit is there, legal audit, 5 crores and above, we are conducting legal audit. In such cases, it is not required as EC obtained as a part of legal audit. Legal audit is done by other advocates. So at the time, they will obtain EC. So in such cases, it is not required. Fee payable for obtention of EC is 500 rupees plus fee charged by government. I think these are also covered. Next. This, of course, sir, Jagannath sir has covered this. You have to release documents within 30 days after closure of loan. Key fact statement, already we have covered this. Off balance sheet exposures regarding bank guarantees and letter of credits, bank guarantees. Bank guarantees, guarantee 50,000 and above should be signed by 2 authorized signatories. BG is 5 crores and above, quarterly status report. We have to collect status report. When you are giving BG for a particular project or something, there you have to call for progress quarterly and monitor. Next, third party deposit not to consider for margin. Normally at the time of issuing BG, we say 25% margin you have to bring fixed deposit, KDR. So party says I am having my friends KDR or my family members KDR, no question. Only self KDRs, deposits only accepted. Third party deposits are accepted for collateral security, not as margin. That is one. And BG for period more than 10 years, it is HO, CGM or GM, HO, CSC and above authorities, they can give. Sometimes without period also, they insist. In such cases also, HO, CGM and above authorities, they can issue beyond 10 years and without period. Minimum margin requirement for bank guarantees beyond 5 years. It is in the form of how much it is? 25% in the form of KDRs. Right? Next, guarantees favoring other banks. Similarly, earlier we have seen financing against guarantees issued by other bank. Similarly, now we are issuing guarantee in favor of other banks. Such cases, same 3 years good dealings. Party should enjoy 10% fund-based limits with us. Then only we can give. And minimum 1 crore guarantee amount. So these three aspects. Such guarantees all put together should not exceed 10% of our tier 1 capital. This is exposure now, prudential exposure now. Similarly, in LC, sometimes they are asking some definitions. What is the definition? First one is clean letter of credit. Normally, letter of credit should accompany documents, title of the document. Suppose any goods are coming, like your shipping bill, airways bill, like that, it has to accompany. If such documents are not coming, if seller is not required to tender documents of title to goods, like airway bill, shipping bill, etc., for obtaining payments, it is called as clean letter of credit. Next, branches shall not open without recourse clause. Status report or OPL should be called. Normally, while issuing, we will beneficiary status report we will call for. Suppose it is a government party, our party. In such case, it is waived. OPL may be waived for good record at least 2 years with us. Okay, good companies, etc., etc. This we need not worry. TOL is to TW normals. Quarterly report of LCs and BGs 5 lakhs and above, we have to call for monitoring. Standby LCs, several times this question has come in exam. Standby LCs are similar to guarantees. Normally LCs, they should accompany with the document in the title to goods. And on the due date, we will be paying amount to the party. If party's balance is not there, it will be devolved. We will debit to loan account and pay to the LC party who has sent these documents. So in case of standby LCs, here there is no question of supply of goods, etc., etc. Only commitment. So within this period, our commitment is like this. If commitment is not fulfilled, then it will be invoked and it will be amount will be paid. So this is similar to bank guarantee, just like bank guarantee, standby LCs, but maximum period up to 1 year only. It will. Okay, non-constraints we need not worry. So this credit policy we have covered, and credit risk management policy. What about I will talk with sir. Again, it's another chapter. Shall I?
Sir, okay. Sir, you can unmute, sir.
Okay, sir. Friends, almost this credit policy I have covered, of course, with a little fast also because it is a big subject. Otherwise, it may take still more time. But wherever required explanation, I have taken care. Where that not that much important, I have skipped or went fast. So this is about my session. And another one, credit risk management policy is also there. That is also a little important. That is why it takes another 1.5 to 2 hours time. I think I will cover in next session. What otherwise almost it is 5:15 nearly. So I will postpone it for next session. That's what I talked with Sir also. So today we will wind up this credit policy section, and again we will continue CRM policy next session, sir. Yes, sir. Anand, sir.
Yes, sir. Thank you, sir.
Thank you very much, sir. Yeah,
Thank you,
yes.
sir. In one of the in the week, next week, coming week, one of the days, in the
Yes, sir.
evening,
Yes.
we will have your session, sir, definitely.
Yeah. Anytime that
Actually,
we
Monday
have
and
to.
Tuesday, we are having MSME, that is retail lending.
Yes, sir.
So Wednesday, Thursday, and Friday we will skip because Wednesday and Thursday we will skip because it is
Yeah, yes, sir. Correct, sir.
either first or second.
Yeah.
We will have your evening session, sir.
Sure,
So
sure, sir.
we can complete that
Yeah.
subject.
Credit risk management policy. All exposure ceiling norms are there that.
Sir,
Uh,
many people have asked your PPT.
Yeah, you can share it, sir. Because,
Sir, friends, for
but
your information, we have
but
already shared.
I can tell whatever I have given Word file, that PDF file, same file only I have copied in this PPT, sir. Because
Yeah,
letters will be little bigger in PPT. That only with that reason.
we have shared that
Yes,
PDF
yes,
file
sir. Yes,
yesterday itself.
yes, sir.
Those who are in the group, you can access to that PDF file. If you
Yes, yes,
please join the group.
yeah,
If still you require, please drop a message to me. I will share.
yes, yes, sir.
Okay.
That's right.
PowerPoint is for the benefit of viewing in the class video.
Yes, exactly,
It was
exactly.
prepared. I think you can go ahead with that PDF, which you can, if you want, you can take print also.
Yeah,
It will be
yeah,
definitely useful not only for promotion, for our
yeah,
functioning in the
yes,
branches also.
yes, yes, yes.
Yes, sir has exhaustively covered the entire subject. Thank you, sir.
Thank you very much, sir. Thank you.
Thank you
Thank
for
you.
sharing your time. Thank you, sir.
Yes, thank you. Thanks. Yeah, I've shared. Yes.
Those who are not in any of the group, I am posting the link here. Join this group. There, all the materials are shared. If required, we will share once again also in the same group. If you want, I will share the PDF here. Friends, if you can wait, I will share the PDF. I have shared the credit CRM file shared by the sir. People wanted PPT, that also I am sharing. I'll share the CASA also. I am now sharing what Mr. Jagannath sir has shared for MCQ on credit matters along with the answers also, and deposit PPT also I am sharing. Tomorrow classes will be started by sharp 10 o'clock. Please join us. Mr. Jagannath sir will handling the session. It will be on OTS policy. Shortly, I will be sharing the link for tomorrow's session. It will be shared in all the groups shortly, the maximum by 1 hour. Thank you all of you. I am winding up this session.